First, we will start with, and I'm inviting you to the stage, Menno Middeldorp, Global Head of Research of the Rabobank and more than 20 years of experience in international finance. And thank you. Theo Kokke, Professor of Risk Management at the VU and also Chairman of Cardano Development. You will hear more about that. And they're going to have a discussion led by Thomas.
Thank you, Deborah. So we just heard a lot about the digital euro. I have a switch at the back. Okay. It should be working. Yeah? Okay, great. So we had a discussion about the digital euro, but of course we have many more currencies in the world. Some countries have their own currency. Some countries use, for example, the dollar for every payment in their own economies. And this has repercussions for the people who are living in these countries. It has repercussions for trade. It has effects on the society. And this global financial system is even more intricate than what we drew in the map that we already have. So right now we're going to have a discussion about what does these international dynamics of money have for effect on our societies. And we're going to have this discussion with the two gentlemen next to me. And Menno, you worked before you joined the Rabobank for the Bank of England, the Fed of New York, and the Hong Kong Monetary Authority. So you've been to all these jurisdictions and different kinds of money. Can you tell us a little bit about this international landscape of currencies and money?
A little bit.
A little bit, because we only have 25 minutes.
Exactly. As you say, it's even more complex. But I think one aspect to think about is like the hierarchy between the currencies. And what you mentioned already that there's some countries don't have their own currency. They just use somebody else's. That's the minority. Most of them have their own currency. Some of them link that currency to another currency so that they don't really have autonomy, but they have technically their own currency. But if the dollar goes up, their currency goes up. If the dollar goes down, as long as they can maintain that link, which is a whole thing in itself I won't get into. Then you have currencies like the euro, which are, we use it here in the euro area. But there's also countries around us that use it. There's countries in Africa that are linked to the euro. But it's a kind of a regional / limited kind of international use of the currency. The euro is the second most internationally used currency out there. And then, of course, there's the other one. I don't even need to mention the name. I'm sure everyone knows that the dollar is the dominant world currency right now. I think there's different ways in which you can use a currency. You can use it in the foreign exchange market. You can use it to transfer money. You can buy treasuries and store your money in it. But if you kind of average all those things out together, basically everything that happens in international finance, like probably around 2/3 of it, roughly speaking, is dollar-based. So obviously here in the euro area, you can spend days without having to see a dollar, but once you transfer money outside, there's a good chance it's going to go through that dollar system. And there's other currencies, as we mentioned before, that are really dependent on the dollar, that are much more dependent than we are. So that's part of the complexity of the system, but one of the interesting features is this kind of hierarchy. And it brings benefits to the US. Basically, they get free money, not free, but they get much cheaper funding for a lot of things than they otherwise would. They also get power, geopolitical power. So when Ukraine was invaded by Russia, the US used that power. When there was a fundamental disagreement about nuclear weapons with Iran, the US used that power. And that is beginning to rub some countries that don't agree with the US on everything, like China and Brazil, the wrong way, as it were. They're trying to find ways of kind of distancing themselves from this dollar-based system. And one of the places they're looking is they're having their own digital currency and then using it not just for their own country, but also finding ways to make it interoperable with each other so that they can get around the dollar system.
Okay. And for so the dollar is the dominant currency, then you have the euro, the Chinese renminbi, and then all these local currencies in different countries, like the Argentinian peso. Can you explain a little bit why you want to have your own currency at all? Why is it important to have a currency for yourself, for your own country?
Yeah, I think, so here it gets, the geopolitical element is becoming increasingly important. Just having power over your own economy from a political perspective, the currency is an important factor in that. When you have your own currency from an macroeconomic perspective, you can have more control over your own economy, because just like the ECB can hike interest rates to slow the economy down or cut interest rates to speed it up, they can adjust interest rates to what the economy itself needs. And if you have an independent monetary policy with your own currency, you can do that. But even if you do have your own currency, it doesn't mean that you can build the faith and the trust of your own population in order to be able to do that effectively. You have to run monetary policy well for many years before you get that reputation. And that means that often currencies, even when they have their own currency, they still end up linking to another currency. And then there's kind of, I think, another thing that's related to this, which is separate, is, you know, obviously if you have your own, how well the financial system in a country functions, and that's not necessarily related to whether or not you have your own currency or not. You know, theoretically, you could have a perfectly well operating banking system if you're using the dollar. The only thing is, the Fed won't get behind your banks if something goes wrong. So you lose the ability to support your own financial system with your own liquidity creation at the moment that you have financial stability. But like I said, not all countries manage to have their own population have enough faith in their currency that they can actually use their own currency.
Is it possible to make that happen, to have if you, for example, take Argentina, they have huge inflation every so many years. So why don't they manage to get a stable coin that they can use?
There's choices that need to be made, sacrifices sometimes, to be able to manage your own currency. You need a central bank, or you either need an independent central bank that's allowed to do it, or you need a political system that has the wisdom to do it. And that's difficult, because the short-term gains are often easier to print some extra money, finance your bank, finance through your central bank, finance the government finances. That can, as you mentioned earlier, that can be benefits to that. You can increase spending, but it also means you create inflation often. And if you get into that wrong cycle, then people lose faith in their own currency. And so you have to have a well-functioning, you need kind of an entire political system that functions well enough to maintain that faith.
I'd like to bring Theo into the conversation, because Theo, you have been working a lot in countries with not so stable coins, and you've been doing that, that's a euphemism, but you can explain that later. But you've been doing that from Cardano development. Deborah already asked, what is Cardano development? What are you doing with Cardano development?
So we initially started in 2007 when development banks like FMO here in the Netherlands, actually they wanted to have a kind of insurance company to help countries which have local currencies, and they always get loans in US dollars. And then you get a loan in US dollars from whatever, all these development banks, and you have to repay that loan. And once in a while, these countries get into difficult economic weather. And what happens when they get into trouble, their currency goes down, so they have to repay in a dollar that is then sometimes 2-3 times more expensive than it was before. Assume that you have to borrow for your house a mortgage, and you have to repay the mortgage in dollars, and then you want to repay your mortgage and it's 3 times more expensive, or you run a company, then that's trouble. And what happens in these countries is every time they get into bad economic weather, their currency goes down, and exactly at that moment that entrepreneurs in those countries are in let's say, a little bit of a difficult situation, they have to repay 2 or 3 times higher. Like in Ghana recently happened, in the Ghanese cedi, they have to repay their money, and they can't because it's too much, suddenly. Yeah? They have to repay so much. So we want to give them local currency loans, because they don't have their own pension market, they don't have their own saving system, so they don't save enough, so they have to borrow money from abroad. They have a shortage in capital. They need capital, and that capital needs to be, it's better if it's in local currency than if you give it in dollars. But usually these development banks only wanted to give it in dollars because a dollar is safe to them. And now they can give it in local currencies, and then they can protect themselves in this fund. Then you might think this fund is full of risk, but all the development banks in the world decided to put money into that fund, and that's now called TCX fund, and that's a protection fund for all the currencies in let's say, very low-income countries. And then we, at some point, FMO said, Cardano, I was running a company called Cardano.
FMO is a development bank.
FMO is a development bank in the Netherlands, a big one in the world.
So can I summarize?
Yeah.
So we have a lot of capital here in the Netherlands, in Europe, in the US. There's a lot of excess capital that wants to look for a good investment opportunity. And in these countries, they don't have enough money to invest in but they do have the projects, they can build roads, and they can develop the country. So they need money from abroad.
Yeah.
But then the investors say, well, we have dollars or we have euros, and you can borrow it in dollars, but we want the amount back in dollars.
Yeah, take it or leave it. Yep, that's.
But then the money goes to these countries, and then they use their local currency, or how does that part work, and where does the fund come in?
Well, so far in the past, they would get a loan in dollars. Mm-hmm. So a local entrepreneur would get a private loan, because these are all about private loans. So of course, the governments are also borrowing in dollars, which is also a problem. And these local entrepreneurs, they have to borrow money from the development bank in dollars, or in euros sometimes. And now we change that thing into, they can also borrow it in local currency, and then they are much more stable. But then the development bank has the risk, and they all share the risks between all the development banks in the world, because one development bank is in sub-Saharan Africa, the other development bank is in Inter-American Development Bank is in Middle and South America, some are in Asia, EBRD is in Eastern Europe. So they all share in the same fund to share the risks.
Because the entrepreneurs who borrow the money, they are gonna have their business in the local economy, and they're gonna do business in the local currency. Then that's the situation. And then they have income in the local currency, but then suddenly, because of some shock or mismanagement, the exchange rate goes down, and then they have a big problem because they need dollars, and they need to buy them.
Yeah, and then they need to buy them against a much higher exchange rate. And then they are in deep shit.
And what do the investors say if you...
I want to say they're fucked, but I thought deep shit is better, but it's both wrong.
These are technical
I don't
terms.
know the right jargon.
I think everyone understands.
What do the investors say if you say, okay, this is a problem, you need to lend your money, but you need to denominate it in the local currency, and you have to take the currency risk?
The investors usually, they hardly want it. They don't want to take currency risk in many Asian or African countries. They think it's too high. So local currency financing is a big issue. And recently, there was this, in Paris, there was a big global G20 finance, development finance summit, good word. And they at the end, one of the statements was, we need more local currency financing, and the IMF and the World Bank need to work together with TCX, that was literally mentioned, to make this much bigger, because now we only do something like 5 billion. That sounds like a lot for these countries, but we need something like 500 billion.
Okay, so that's 1% is there, and we need...
1% is there. It's,
Okay, so there's still a huge gap. So what kind of solutions do we need to look at? Do you have a suggestion for that?
Well, I think this is the type of solution that could work. So you're never going to get a pension fund to take your pension contribution and invest it at very high risk in a country where they can't hedge the exchange rate, where they can't insure themselves against a drop in the exchange rate, because they wouldn't be doing their job. They'd be taking too much risk unless the return that they were going to get there is really high so that they can pay your pension. But if you then add a small bit of public funding from from aid agencies and say, okay, we take this form of risk. It's only one of the forms of risk, but it's a particular form of risk that you can then find a public solution for, and then we can free up this private capital to go to these countries, or at least increase the flow by solving this particular risk problem. So I think it's a nice example of private-public partnership, and I think it makes sense from that perspective. I don't know. Yeah, the other thing is, of course, countries can do this the hard way by investing in their own financial system, but they need investment to do that. So hopefully, as time goes by, if they have good governance, they'll develop a stable currency that will be, they'll develop a system that has less intrinsic risk, and then over time, they won't need a solution like this. But to get there, this could help.
And you develop it as a private initiative, Theo?
Yes, it's a foundation. We put it in a foundation because all these development banks put their money in. And I think that foundation should even be separate and become a a big international like the World Bank, but then an institute, and that we're thinking about it, or together with the World Bank and other institutes, to make it a big institute that can guarantee all the major flows in the world, that have all the pensions that want to invest in these countries, that they get a kind of currency guarantee via that fund. So it needs to be, because we can't make it 100 times bigger. We need a kind of international institute to make it that big.
And who invests in your kind of fund? Are these rich people, or?
No, only in this Fund T6 are only the development banks. So all the development banks in the world, the Inter-African Development Bank, or the African Development Bank, the Inter-American Development Bank, the Asian Development Bank, the EBRD, the FMO, they all have a stake in this fund, and they all can take risks in this fund. So they can share the risk. And their own money is the cushion to make sure that the risk can be sustained.
And if we zoom out and we look at the division of capital, so we have a lot of capital here in the West, and there's a lot of money needed in the global South. Can't we just expect billionaires and millionaires to just accept that they're going to have a little less return and take this risk for themselves?
Well, they're doing it, but not enough. So, for example, we have a stichting, and in the stichting, some of these people invest in some of our initiatives, and they know they get, we tell them, you get 4%, and it's extremely risky, and they like that. So but it's not in hundreds of billions. So in that respect, I think Rens van Tilburg, he's not here today, but he works with you once in a while, and he said, well, maybe we just need some the SDR drawing rights, we have in the world, that we use this kind of World Bank kind of initiative to use that money to send to the development banks, the DFIs, like FMO or the World Bank, the World Bank is IFC, but all this private, because there's not going enough private money into these markets. And then, for example, pension funds can cooperate with these development banks, which they already do, and then they feel more secure, because pension funds don't have a clue about how to invest in these countries. But now we set up also an institute where they co-invest with these development banks, and then if the development banks get 10 times bigger and the pension funds will co-invest with them, then we need something like 1 trillion more capital into developing countries only for climate impact, for renewable energy and those kind of things, and something like 3 to 4 trillion to solve healthcare and all other things. So that's a huge amount of money, and only a few 60, 70, 80 billion is going into these markets every year, so we're not gonna, it's not going to work this way.
And how important is it to develop the local system so people can start saving, and what can digital technology like, not a digital euro, but a digital Argentinian peso, for example, do in these countries? Can it help the development of local systems,
I don't think it solves this particular problem, because you're still going to have to, let's say it's all digital, you have the local digital currency, you have the dollar digital currency. They're moving against each other. You're still going to have this exchange rate risk. What I do think is that digital currencies give an opportunity for the local economy to increase financial inclusion. So like in Africa now, you see increasingly that people are using kind of financial solutions on their phone. If you could have a digital currency by the central bank that you can directly link to through your phone, that could increase the ability to get maybe data that then could see that you have a track record of spending money wisely, which means you could get access to financing, and then that could then unleash the benefits there. And as you say, it could also unleash local savings, but I think it could also help then for this foreign money to find its way to just maybe like small farmers, who then have more access to finance. And we know from kind of a lot of research that if you do this well, this kind of microfinance can actually both lead to healthy returns and real improvements in local economies. So linking a couple of things together, there's different solutions that are required. Digital currencies aren't per se a solution, but they can be part of the matrix, and especially when we're talking about areas like Africa where they have this opportunity to kind of leapfrog the system, that the leapfrog in technology, like skip the whole complicated interbanking systems that we have now and skip right up to digital currencies and digital means of interaction through simple things like your mobile phone. There's an opportunity to set up a new system through that kind of technology.
Go quickly towards a digital currency and
yeah, just like they skipped. They don't have a lot of telephone lines in Africa, but everyone has a mobile phone. They just skipped that phase. And you can do a bit of that with the financial system as well.
What do you think, Theo? Is that something to skip, and can they move quicker towards developed country, or what is the main problem of developing a local system, according to you?
Well, of course, the electronic money, like M-Pesa in East Africa, and they have several of these, in many countries they have these electronic things. They charge them on their phone, it's easy to pay, they pay everywhere with electronic money. But the digital currency that Martijn was referring to requires a lot of registration of people. And one of the biggest problems I see, for example, in South Africa, where we try to set up savings system, is these people are not registered. They're all coming from Zimbabwe and Mozambique, and we want to give them access to savings via i-registration and things like that, instead of being part of the official system. And if you make a digital currency, for example, in India, they had this ADIR system where everyone should be registered, but 10% is not registered under that total country administration system. If you're not registered, you really have a problem in India. And that's the problem with if you would say, hey, everyone has access to a digital currency and it's really great for everyone. Yeah, but you have to be registered. And in many countries in Africa, that's really a problem because of migration and many... illegal. I can hardly call it illegal. You're just not registered, but they are working. They're not. They don't throw them out of the country like they do here. They accept them. They're happy with them, as they should. But they. This is a political statement, but so in these countries they are happy with these immigrants, and they give them and they work, but they don't have access to the government and to registration. And that would the digital currency that Martijn is talking about is far away for these people, and it is really.
So what is the first step that they do need, and also to make them less dependent on foreign aid or foreign investment, because.
For example, better savings systems where they can save without. Most people don't have access to banks in Africa. And that's really terrible. You know, we can be a bit angry about banks in Europe or America, but the banks in Africa make a huge amount of profits because they only serve the top 20%. We try to we gave people money in Africa and say, try to open a bank account. And we gave 5 women, like an experiment, we gave them a serious amount of money. They couldn't open a bank account. They can't. They're just not interesting enough for these banks. So we need more accessible systems for people to save money. You also have, of course, we all know about microcredits, and that's working relatively okay, much better than before. But there's a lot of things that need to be done that are so normal here, but that are totally fundamentally missing there. But for example, the payment system is much better because of these mobile phones, and they all have a mobile phone, and they all pay electronically.
Does anyone have a question from the audience? Over there. Yes.
Oh, sorry. Hi. Wonderful system. Sounds wonderful. It sounds a bit like a fire insurance, basically, like you spread out your payments instead of having it all in one go. One worry that I see is that in the past decades, we've seen that the global financial system has gotten more and more integrated. And so the crises, they also happen, more of them at the same time, even when they're geographically very far away from each other. So it's kind of like the entire city being on fire at the same time, and your fire insurance might still fail. Is this something you're like? What are your thoughts on this?
Can I start?
Yeah, go ahead.
Because you're totally right. So in the Western world, like if there is a small fire in America, we have a fire in Europe. That's extremely linked. And if America really literally fucks up, then the dollar goes up. So that's really weird, but in 2008, 9, 10, the dollar went up against many low-income country currencies, although they were to blame. But the real currency crisis that they have per country are not really correlated. So they are not, for example, if something happens in Uganda, then it's not that something will happen in Azerbaijan. And so these local low-income countries with their local currencies, they have in their region, they will have a contagion, so their region will suffer. And you see that, for example, when something happens in Ukraine or in Georgia, or then you have the region that suffers. So if we insure them, that region, we lose a lot of money in that region, but in other regions you don't. So you have more that the dollar is, in the Western world, very contagious and very influential in dragging everyone down. But not the local crisis in low-income countries. So in that respect, we can still protect these countries separately. And you have a little bit of local contagion, but not that all these low-income countries go down. Is that a bit of an answer?
We have time for one more question, and then we're going to have the debate, because otherwise...
We'll do it at the drink.
Because this is such a huge topic. We can discuss this for much longer, but that's for afterwards.
I wonder whether these local currency loans are more expensive, because mostly you have to pay for risk. So are they more expensive? Is that a problem?
Yeah, and this is exactly the issue, but I think essentially what's happening here is part of the risk. There's lots of different forms of risk that you take on if you lend. But here, you're also taking on currency risk, and this solution takes away that particular form of risk, which is difficult to get priced well in the market. So the market, I don't think the market works really well. So this is why there's adding this public solution into the mix. You take one bit of risk away that then, for a price, I mean, I think they'll still be charged, but it'll be offered, which will allow the investing side to invest. It solves this market failure, as it were, and that then allows essentially the investors to focus on the other types of risk, which will still mean that it's probably more expensive to lend to Africa, but at least this unnecessary form of risk can be mitigated.
Yeah, so it's a totally fair point. It's also a tricky point for people who would take those loans. Let's assume there is 8% inflation and the US dollar 8% more than in the US, and the US dollar interest rate is 4%. And because you have 8% more devaluation every year, because the currency will go down every year with 8% more, then you already have to pay something like 4 plus 8 is 12%. Maybe the loan will do 13, the 1% for the risk. That's more or less what it is. But then you tell these people, they say 13% is a lot, 4% is lower. I said, yeah, but you get your 8% devaluation already the last 20 years, but once every 10 years, you have a 50% collapse on top of it. So why don't you pay that 1% extra risk premium for that 50% collapse? But if they can choose, they just take a dollar risk, and you know that these people, probably many people here know that at some point people could take Swiss loans because the interest rate in Switzerland was zero or negative. They took Swiss mortgages in Poland and in Hungary for 4% instead of the local 8%, and then they had to and suddenly their whole currency collapsed against the Swiss franc. And they had to repay almost double the amount. But if you would offer people in Holland Swiss loans for a few percent less, they would take Swiss loans. They don't know what they're doing, but they do it. And it happened. They were stuffed full of. Everyone took these mortgages, and so that's another problem. You shouldn't even offer US dollar loans because people are too. Okay. It's too attractive to be fooled.
Okay, thank you, Theo and Menno. It was really interesting. We could continue this conversation, but we have to stop it here. And I think next year, this will still be a problem, so we'll continue talking about this. Okay, thank you very much. And have a nice day.